What is going on, traders? Huge week gearing up for stocks. Is the Fed going to smack the market down or not? This is the high beta ETF. I'm going to tell you why I'm looking at this specifically, especially with the upcoming Fed meeting. Here's what happened the last time this high beta ETF got to this resistance level, and I'll describe what high beta stocks are. Of course, we're going to be doing a broad-based market analysis. And you might have guessed, but this is not the first time that we break out of a long trend line like this. I'm going to go over historically what has happened each and every time the market has broken out in a similar fashion. But the TLDR version is what is going on in the bond market as well as the labor market signals to me that I think the Fed is going to maintain its hawkish stance. I think they will do a 25 basis point rate hike. However, the language is key. The language is what most of the market is going to focus on. So we'll get into all of that. As a matter of fact, why don't we just go ahead and start right now? Without further ado, let's get right into it. So let's start with this high beta ETF. Why are we looking at a high beta ETF? Well, because it contains the stocks that are considered high beta in the S&P 500. High beta is just a fancy word for meaning that these stocks are more volatile than the broader market in general. And so when we are seeing euphoria, when we are seeing, for instance, talks of the Fed potentially pausing or potentially pivoting, which I don't think they're close to pivoting, they are close to pausing. More on that later. But when we start seeing this euphoria, this greed index in the market tick up, then the riskier stocks, the ones that are more volatile, like the ones in this high beta S&P 500 ETF, you start seeing them rally. And we are seeing a very similar rally to what we saw last year when everyone thought that the coast was clear with regards to inflation, right? The first time that we saw inflation numbers start to tick down. But Jerome Powell came out in Jackson Hole. This wasn't even a Fed meeting. This is how this is why I'm interpreting this as sort of this event here as sort of being an urgent one, because Jerome Powell didn't even wait for the FOMC meeting. In August, we had a pause. So the next FOMC meeting was September 2022. He didn't even wait until then. Obviously he's not just looking at a high beta ETF, but this is, to me, a good indication that folks don't normally look at, or that I don't see folks looking at, to determine whether the stock market is in a euphoric state or not. So if we look at this, the high beta stocks were climbing steadily. And in Jackson Hole in August, he decided to sound the most hawkish that he sounded in, you can argue, all of 2022. And that's when the high beta stocks, as well as the broader stock market, started crashing once again before making lows in October of 2022. So we are there once again. This is the weekly chart. You do see this bearish weekly harami forming, although as of the time of this recording, this is still early. But if the Fed is actually looking at the stock market and looking at the euphoric money that's being thrown at high beta stocks, that is one of the concerns that I think they will take into account. Number two, the bond market. The bond market just does not believe what the Fed is putting up right now. If we take a look at this, this is basically the Fed funds futures based on the Fed's projections in orange, and based on the bond market in, or the futures market in blue. And you could see that market participants are actually betting that the Fed funds futures is going to be less than what the Fed is telling us, right? So the blue is below the orange line. So the bond market has not been believing the Fed for really most of this year and towards the end of last year. As you could see, their bets coming in well below what the Fed is guiding the terminal rate to be, or the Fed fund futures rate to be. Now, there is an adage that the bond market is always right. In my view, the bond market is way more right than the stock market. The stock market is where the euphoria and the fear and all that stuff goes, and the bond market is more measured and tries to tell us what the state of the economy is, right? The stock market is dislocated too many times from what the economy is doing. Very rarely in the bond market do you see broad-based dislocation like that. However, in the early 1980s, the bond market was very wrong on the inflation picture, albeit in this case, the reverse way, meaning they thought that the Fed had not successfully brought down inflation yet. So they were betting that inflation would actually come back in a violent way. And after that 20% Fed funds rate by Paul Volcker, inflation actually went away forever or for a prolonged period of time. And so the bond market actually had at that point guessed very wrong. And inflation was, as a matter of fact, slayed finally in the 1980s up until this point where we have the highest inflation since then. And if we take a look at the 10-year Treasury yield, you could see that it has crashed a full percentage point from the high that we saw in October 2022 until just a couple weeks ago. But I do think that the 10-year yield is going to start ticking back up, and the spread between the 10-year and the shorter term yields, like the 10-year 3-month or the 10-year 2-year, you're going to start seeing those yield curves flattening a bit and looking closer to normal. So I do think that we will see a tick up slowly on the 10-year yield. And if you guys actually watched my last video, I gave you a free play. I said that shorting the 10-year Treasury note futures on the hopes that the 10-year yield will start ticking back up. This was a winning play. If you had shorted it from that video, you would be up over $1,000 per contract at the moment. I do have a target for that short around the golden pocket here, which is also meeting at the long-term trend line again that we've seen since October 2022. So what is the Fed going to do, and how can this affect the market? Well, if we take a look at the S&P 500, what's upcoming, not only do we have the Fed, we have the jobs numbers, the unemployment report on Friday, which is going to be key, and I will contextualize that for you. But we still have some major earnings up ahead. We have some big companies, some mega cap companies left to report, Apple, Amazon, etc. However, so far, out of the 143 companies as of the time of this recording that have recorded earnings, we have had a net earnings surprise that is extremely paltry. This is the lowest net earnings surprise since 2008. We have not yet had a negative bar here. I do think that is likely upcoming at some point this year as the economy continues to contract, but we have not had a paltry net earnings surprise like this since 2008, which means a lot now is riding on the rest of the companies left to report. Now, what that means in terms of the S&P 500, I've stated this before, we do have this really nice inverse head and shoulders here, which is usually a short-term bullish signal. But if the companies report negative earnings and or negative guidance, right, the companies left to report, especially because now they have to do more pulling, right, they got to pull more weight because of the fact that most of the companies that have reported have had a almost net negative earnings surprise. If the rest of the companies, especially Apple, do not impress, then look for this swing failure pattern, meaning, yes, we broke out of this trend line, but we could easily get back below it, especially now if the Fed is actually hawkish on February 1st, which I think they will be. Again, a 25 basis point rate hike is in the cards. However, their language about not pausing anytime soon until the fight is over, I think they're going to get very aggressive with their language, especially since the labor market is so strong. Remember, we have unemployment on Friday. So because the labor market is so strong here, if you look at where the Fed officials want unemployment to be, they want unemployment to be at 4%. Remember, the last unemployment came in at a record low since 1969, 3.5%. So if earnings come in less than expected and or guidance comes in less than expected, and we have a strong jobs number on Friday, that is going to be really a recipe for disaster. And lastly, I want to give you a glimpse of what has happened historically when breaking out of long trend lines like this on the S&P 500 specifically. This is a very fascinating and complete compilation of that event put together by a Twitter user named Yuri Matzo. So shout out to Yuri. Apologies if I'm mispronouncing your name. But if you look at this, you could see that this currently is where we stand, the 2023 breakout. So here are breakouts that led to all-time highs. 2012, was this a recession year? No. 1982, was this a recession year? Yes, this was breaking out of a recession year. 1971, also breaking out of a recession year. 1967, did we have a recession then? No, that wasn't a recession year. 1954, that was breaking out of a recession year. And then obviously 2008, these are the breakouts that failed. So 2008 failed. and we actually popped really nice above the trend line, looking like, you know, the recession was finally over. Same thing in 2002 and then in 1940. So most of the time that we have broken out of this trend line, we actually have gone on to not only seen a bull rally and a bottom to the bear market, but the market has gone to all-time highs. So looking at this, what are the conditions? What are the current conditions, right? This is definitely a euphoric rally that is spurred by the fact that, you know, the soft landing picture could be possible. Unemployment is still very low. We see inflation trending down. There are hopes that the Fed is going to pivot. There's no evidence for that. And again, the bond market is telling us that they don't believe the Fed whatsoever. And now we're starting to see the stock market not believe that either. If I had to guess, because of the strong labor market and the fact that the Fed sees wages and the low unemployment as not only an enemy, but an enemy that can cause a nightmare scenario in the way that Michael Burry had recently described, where inflation could come back roaring if the Fed actually takes it easy, if the Fed goes premature and takes it easy, partly because the labor market is so tight, right? This is a very unique condition where the labor market is really acting in a stubborn way in the face of so many rate hikes. So I think the Fed is aware of that, and I think that the Fed is going to focus its language on February 1st on the tight labor market and the fact that they really need to basically break it, unfortunately, basically break the labor market so that unemployment goes above their targeted 4%, which is plain for everybody to read, right? So if my projections on how the Fed will sound, how hawkish the Fed will sound are correct, I do think this will be a short-lived rally. This will be a bear market rally, and the conditions, although are easing, the tight labor market is really the scariest enemy of the Fed at the moment, especially based on the history that we have, where, you know, inflation can come back roaring and has come back roaring if the Fed actually does act prematurely and takes the foot off the gas. Now, I do think that they will pause and keep rates higher. And I think that they will pause because of the fact that the 2-year yield is now below the Fed funds futures rate. And I've talked about this before, but raising another 25 in February and raising a potential another 25 in March and keeping rates up there is still a pretty restrictive policy, especially if they keep those rates at those levels for a prolonged period of time. I know it's a complicated picture and everybody wants one answer, but unfortunately, that is not the way that things go. And, you know, maybe if you just wanted one answer, this game isn't for you, because the answer is multifaceted, right? We are going to be looking at the mega caps that are left to report. If they follow this picture here, then that is going to be tough for the market to continue this rally. And if the Fed is actually hawkish in its language and says and doesn't give any indication that it's going to pause at any point and that it's just going to keep rates there and that they have to crack the labor market, then expect this to be a short-lived rally as well. And if the jobs numbers on Friday come out really strong once again, expect that to be a negative catalyst as well. In other words, the only way we get back to all-time highs from here, and the only way that this rally actually sustains itself, is if the Fed is dovish, if the earnings and guidance are good, and if the jobs numbers come in worse than expected, meaning if the unemployment rate is actually higher than expected. So that's my perspective. Take it for what you will. Let me know in the comment section what you think. If you want access to all of our trades, all of our futures trades, options, the stocks that we currently bought, we actually just bought SOXS, which is a bearish play on the semiconductors. That is up 8% today. And I'm also trading earnings for Meta as well. So if you want access to all of that stuff, link is in the description below. Would love to have you. Let me know what you think. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.